Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending December 30th. A lot of sideways price action this week and low volume. Not surprisingly, with a lot of people probably taking the week off. Expect to see probably a lot more volatility pickup and some more directional price movements going into the new year. And so let's dive into the charts and take a look at what we're seeing. Starting out with the cryptocurrency market, looking at the Bitcoin chart here. Bitcoin's currently sitting at about 16,500 and is looking bearish to me right now. We've got a trend line resistance in place here with this wedge, and it looks like so far it is being respected. And as long as it does, then there really isn't any other way to go but down from here if it does respect that trend line. So looking like there's a decent chance that we could be heading lower on Bitcoin, and that's still been kind of my more medium to long-term bias on Bitcoin, is that we are likely going to be putting a lower low in, and so we are also below all of our major moving averages, including our 10-day and 21-day EMAs. And so unless we see some price action get back up above 17, I think it'd be pretty hard to be anything but bearish right now, and really anything below 18K would be at least neutral to me. I need to see a price break above 18,000 to kind of potentially change to a bullish position on Bitcoin, which is at an anchored VWAP position, which hasn't been breached to the upside with any kind of daily close since we've lost that level, which was back in November. So definitely looking for some downside pressure in Bitcoin, and some of the price targets to the downside that we're looking for might be some support right around the 14K level. But I'm ultimately looking for a drop down to about 12K or so as kind of the next major area of support. And so either 14 or 12K would be kind of the two next price targets to the downside I'll be looking for on Bitcoin. And then take a look at Ethereum. We are also below 1225 on Ethereum. And so as long as we're below that level, I'd definitely be bearish on Ethereum as well. Potentially looking for that downside price target of about 900 or so for the Ethereum coin. And then when we take a look at the total crypto market cap, also looking bearish here. We are sitting at about 758 billion for the total crypto market cap, but we are also below all of our EMAs. We also had pretty big trend line support and resistance zone right around 762, and we are currently below that just a little bit. So as long as we stay below that level, I think there's a good chance we're ultimately heading lower on the total crypto market cap. So pretty good time, I think, to just either not trade the cryptocurrencies, or to, if you are looking for some profit opportunities, I think the only profit opportunities are really on the short side right now for the crypto markets. And then jumping over to the S&P 500, we actually had some pretty sideways price action this last week, and a little bit of the previous week as well after a bit of a sell-off. We did have a couple of weeks ago where we started potentially hoping on a Santa Claus rally as we broke that trend line. Got above the 200-day moving average a few times, so people started getting a little excited and bullish. I think we might actually break that trend line. Ultimately, we did open above it, but then saw a major failure and ultimately headed lower from here. So this to me looks like it's more of just a bear flag, kind of chopping around sideways. And unless we really see a measurable move above about 390 or so, I think we have to stay bearish on the S&P 500 as well. Likely looking for some further downside in the markets. I think that's a pretty smart bet for the broader markets abroad based on this price action right now. And it looks like the S&P is likely going to be heading lower from here. And we'll keep a close eye on that. But as long as we are below that 390 level, I think we've got to be at least neutral to bearish in the broader markets. And then when we take a look at our breadth measures in the S&P 500, we can see that we are chopping around right around that 50% level. And one interesting thing I noticed, that every time we've actually seen the S&P 500 be above the 50 level, 50% mark, and then ultimately drop below that level, then that was a sign that the markets were selling off. And so we did finally get back up above 50% of S&P 500 stocks above their 200-day moving average for the first time since early 2002, and we did spend a little bit of time back up there, and now we're just kind of chopping around. So if we do see a major failure off of that 50% level for our 200-day moving average breadth, then I think that will be a very bearish signal that we'll probably see another leg lower in the markets. And we're also seeing in the 50-day moving average breadth that we actually did break below where we had previously bottomed out back in early November, and we are just chopping around right around that level, maybe slightly lower. but that's also looking a bit bearish. And if we see that 50 level break to the downside on our breadth measures for the 50-day moving average, then I think that's also going to be a pretty bearish sign for the markets. And then take a look at our NASDAQ. We are below a key area of 270. As long as we're below 270, really can't be long the NASDAQ, in my opinion. We're also below all of our major moving averages currently, including our 10-day EMA and our 21-day EMA. So as long as we're below all those moving averages, things are still looking pretty bearish for the NASDAQ. We may chop around a little bit sideways. We haven't. We're a lot closer to the previous lows that we put in October than we are in the S&P or the Dow. So we might find a little bit of support around there, as well as at that 259, 260 level on the triple Qs. Looks like could be some areas of support for the short time being, but going forward, once we do lose those levels, and I do expect that we will, I think there'll be a much further downside in the technology space as well. And then take a look at our Dow Jones Industrial Averages. We were starting to look a little bullish there as we were starting to see the Dow hold above that 50-day moving average, but ultimately it did fail midweek. Did get briefly above it on Thursday, and then we ultimately closed lower on Friday, and then ended up closing the week out below that 50-day moving average. So looking like a little bit of hope maybe in the Dow, but now as we've seen that close below the 50-day, definitely starting to look a bit bearish on the Dow Jones Industrial Averages as well. And then when we take a look at the Dow Jones Transports, also looking bearish there. We're below all our major moving averages, and we're just kind of chopping around sideways for probably about the last week and a half or so. So if we see the DJT lose about 13,250, then I think we'll likely see a leg lower from there, and we'll probably be looking for that anchored VWAP position as some possible support at about 12,462 currently on our transports. So the broader indices as well as the transports, definitely not a lot of bullish price action from what I'm seeing right now. And then when we take a look at our Russell 3000, we are also just chopping around the last couple of weeks sideways. It does look like it's trying to hold support above our 200-week moving average, and that is a pretty key level to watch for. So if we do see a break below that 200-week moving average, however, I think that'll be also a bearish signal that we'll likely see a bigger leg lower in the markets. And so that 200-week moving average currently is sitting right around 2152 on the RUA, and that's our Russell 3000 chart. So if we see that price action close below that level, then I think that's a pretty big bearish warning for the markets. And then when we take a look at our Russell 1000, our large caps, we are ultimately holding just above the 200-week on that one as well. But we are also below an anchored VWAP position at about 213. So I think if we're below that anchored VWAP, we've got to stay bearish. And then if we ultimately see large caps lose that 200-week moving average, then we'd likely be looking for large caps to head down and likely retest the previous highs before the COVID crash, which is about 189 on the IWB. And then taking a look at our small caps, this is one of the few charts that I looked at this week that actually is sort of looking somewhat hopeful, and a lot of times small caps tend to lead the market. So while most of the charts I'm looking at are pretty bearish, small caps are ultimately holding pretty aggressively above that 173.50 level, which has been a key area of support and resistance going back multiple years. And we did ultimately drop down below those levels 2 weeks in a row now, but we've ultimately closed the week out both times above that level. So I think that's somewhat bullish looking right there. However, if we do see small caps move up, maybe that would signal a small brief rally in the markets as well. But I don't think there's much room to go. When we look at the S&P 500 chart, we have that downside trend line support, resistance rather, that has not been able to break through, and I think that would likely be the extent of that rally there. And then on the small caps, if we saw it, we'd likely get up and retest this down channel trend line here as well, which would likely only be between about 175 and maybe 180 or so on the IWM. So not a lot of room for upside if this does ultimately rally briefly. We may get that. A lot of times when everybody gets really bearish and things are looking real bearish, sometimes we'll get a little bit of a pop in the markets, and so maybe we do see a little bit of a rally starting the year. But if we do, I think it'll be short-lived, and I'm still really betting on mostly to the downside or neutral on the markets currently, as the small cap chart is about the only thing I'm seeing right now that's looking somewhat positive. And then when we take a look at our growth versus value, we can see value is ultimately outperforming once again anytime we're going down and to the right. That's value outperforming growth, and so we've tended to see growth sometimes outperform value in some of those bear market rallies. And that's oftentimes been kind of a good signal that we've got a bear market rallies. We ultimately start to see growth outperform value, but right now we're continuing to see value outperform growth, and so that's also, I think, a bearish signal for the broader markets that unless we really see this trend line break and start to see a growth rally, we're likely not going to see a rally in the markets either. And then taking a look at our last week of the year for all the sectors we track. Like I said, there was a lot of low volume this week, so didn't really anticipate any huge moves, although we did see a few kind of surprises, I think. We saw energy ultimately do pretty well. We saw that rally this week with about 2 to 3%. The XLE actually almost up 4%. We also saw some positive moves out of cloud computing, retail, and then gold had a decent week as well. We'll get into the gold chart here in a little bit, and then our fintech actually had a pretty good week at about 1.5, and then silver had a good week as well, about 1.5 as well. So a lot of sectors actually slightly in the positive, anywhere from less than 1% to 2% of gain. A lot of other sectors really kind of close to flat. And then ultimately at the bottom here of our list, we can see that nat gas sold off once again, down almost 11%. I do think nat gas is pretty close to a bottom, and we're likely going to see a nice rally out of natural gas pretty soon. But it has been very beaten up over the last few weeks, really. So I do think there's a potential opportunity there. And then we're also seeing the TLT sell off a bit, down 4% on the week as we started to see interest rates go up. And then solar was also a pretty rough sector, down about 4% on the week. And then diving into our oil chart, we did see energy move to the upside, and we also saw oil move to the upside this week. We've actually had 3 positive weeks in oil prices, although I do think there's a good chance that we're going to roll over from here or pretty close to here. We can see, going back at looking at this white line as our 10-day EMA, the yellow lines are 21-day EMA, or week rather, and each time we hit those levels, we oftentimes reversed, or really every time we've reversed ever since the sell-off has started. And so the 10-week EMA has been a pretty reliable reversal point, and the few times we've broken above that, we've just really gotten up to that 21-week EMA and then seen a reversal. So I think there's a pretty good chance that if we do see another 4th week going into the year of some positive oil prices, that it would likely top out at 85, and then I'd be looking for a rollover from there. I think there's still a pretty good chance that we can get back down and retest that 200-week moving average, which is currently at about $65 a barrel. We might even get as low as about 60 or so. I wouldn't expect that we'd get much lower than 60 a barrel to the downside. And then I ultimately do think going into 2023 we'll get a nice energy rally at some point. But I don't know if that's going to be first part of the year. I think there's a good chance that energy actually maybe underperforms to start the year. But ultimately at some point in 2023 it'll very likely, I think, have a pretty strong period to trade and go long on the energy stocks once again. It was definitely the best sector in 2022, and I think it'll have a pretty good 2023 also. And then take a look at our commodity prices. We're ultimately still hanging above that 267 level. If we can see our CRB index drop below 267, I think that'll set us up for a pretty nice short. As we've talked about multiple times, but each time we got down there, starting to think, oh, this is maybe it. We're going to maybe see a nice short down to the downside, maybe at that 243 level or lower, and ultimately we've just kind of bounced back up each time. So that 267 has been a very strong area of support for the CRB index, and as long as we're above that, I think you do have to be somewhat bullish, but I also don't know if we're going to see any massive rallies in the short term. So I'm really more kind of on the neutral side when it comes to the broader CRB index, because we are below that 50-week moving average, and as we can see on this chart, these are weekly candlesticks. We've really just kind of been chopping around somewhat sideways. We've had some strong up weeks, but then generally they're followed by a week or two of downward pressure, and ultimately we've just kind of been chopping around sideways really since about September or so. So I'm pretty neutral in the commodity space right now. And then taking a look at our global index minus the United States, we can see that it's our weekly candlestick, so we're kind of sideways for the last couple of weeks in the global markets as well. But I think the bias is still likely to the downside, and we'll likely be heading south looking for that 4750 support and see if we head lower from there, or then potentially get a bounce off that 4750 level for the global markets. And then take a look at our HYG, our corporate bond ETF. This is looking a bit bearish as well. We can actually see some interesting trend lines developing here throughout the year on the HYG. And then at the bottom chart here, I've got split off is our S&P 500 index. And we can actually see an interesting correlation here where the last 2 times we saw the HYG top out at the top of this trendline channel, that ultimately was a signal that the top was in on the S&P 500, and then we were heading lower from there. So if you would use the HYG chart to essentially go short the markets, each time it topped up here these last few times, it ended up being a pretty good play so far, and it looks like we are just rolling around at the top of this, potentially getting ready to roll over from here. So that's also, I think, looking pretty bearish, that as long as we're just chopping around at the top of this trend line, the most likely bias, I think, and most likely direction that we're heading in the short term is to the downside. The only thing that would really change that would be if we saw price action obviously break through that trend line, because we haven't seen the HYG do that really going all the way back into 2021. So this is a pretty multi-year trend line support and resistance area, and so if we do see it break the resistance and then ultimately hold as support, then that would be a trend shift, and I think we'd have to start looking at potentially being bullish, but I don't think that's very likely, and so I think the most likely bet on this is to the downside for the markets. And then take a look at our precious metals, starting out with gold. And gold's actually had a really strong move starting back in November, and then this last month in December we really seen some positive price action, but a much slower move. And typically when we see these patterns, usually they'll materialize to the downside once we see a trend line break. That doesn't always happen that way, but the more often than not, you're going to see a trend line break to the downside and then likely see a correction. So I think what we're likely looking at here is essentially a wave 1 to the upside using some Elliott wave analysis, and then we'll likely see a wave 2 correction to the downside that will correct that wave, setting us up for a really nice move with a wave 3 to the upside for a much bigger move going into 2023. So people are really getting bullish on gold and silver right now, but as what happens often, I think when a lot of people start getting bullish and think, oh, it's time to buy gold and silver, that's right about when it sells off and corrects. And so I don't think this is necessarily the greatest entry point. I think there's a really high probability we're going to see some sort of corrective structure in gold, potentially down to at least the 0.382 retracement, which would put us at about 163 on the GLD, or maybe even as deep as a 0.618 retracement, which would be pretty common, and that could get us down to about 158. So somewhere between about 158 and 163 is where I'll be looking at for some sort of a correction. Once that materializes, then I'll definitely be getting long precious metals again, because I do think there's going to be some nice upside trades going into 2023 on both gold and silver. And then take a look at the silver chart here. We've got a nice move up on silver as well, but I do think we are getting putting in a topping pattern here on silver, and then we're likely going to see a corrective wave to the downside. We've got our 200-day moving average currently sitting at about 1960 per ounce on silver. That's also right around the 0.5 retracement level, so that might be a logical area for silver to correct to before maybe finding some support and then ultimately heading higher. But I'll be looking for that corrective structure most likely in gold as well as silver here pretty soon. And once we get it and we ultimately see the prices head higher from there, that's when I'll likely be getting long gold and silver. And I think that'll be a really good trade setup going into 2023. And then taking a look at our interest rates, we can see that the 2-year is up a bit, and we are likely going to be retesting that 4.5%, looks like. We may potentially be heading a little bit higher in the 2-year. If we do get above 4.5, we would likely at least get up to that 4.75 level where we topped out a bit, or maybe we can get up to that 5% level for potentially an ultimate likely top, I think, on the 2-year. But right now we need to clear 4.5 first, and I think that's probably what we're going to do, is likely see a retest of that at least, if not even see the 2-year head up a little bit higher. When we look at our 2, 10s, and 30s, they're all starting to look a bit bullish in the short term. I don't think we're necessarily going to see new all-time highs. The 2-year I think is definitely possible, but I think when it comes to the 10 and 30, there's a decent chance that the top has already been in on those rates. And when we take a look at that 10-year, we can see that we're ultimately above our 50-day moving average there and looking pretty bullish. likely going to retest the 4% level on that one, and wouldn't surprise me if we potentially maybe put a double top in, and that would be right around 4.25, 4.3% or so, and then maybe we would see a rollover from there. But I think it's a pretty good bet that the top in rates is likely in on the 10-year, and so I don't anticipate that we'd get much higher than 4.35% at the maximum on this rally, and then likely see rates head lower from there. And I think that's also ultimately when that does happen, once this current rally in rates is over, I think that's going to be a really good setup for some bond trades once that happens. But we got to be patient and wait for this current rally to kind of wear itself out, and then I think that's going to be an excellent entry point for some bond trades. And I don't generally even do a lot of bond trading, but I think going into 2023, bonds are going to be a great place to be, and I think there'll be some really good trade setups there, and it's likely going to be fairly soon in the first quarter once this interest rate bump subsides. And then taking a look at our 30-year, we're seeing it just testing that 4% level. It's also holding up above that 50-day pretty bullishly, and so I think if we see that price action get above 4 again, we could ultimately see a rally in the 30 as well. But I also think it's pretty unlikely that we would get back up above the highs, which was at about 4.45% or so. Pretty unlikely. I think we'd get above 4.5% on the 30-year. But maybe we do get all the way back up and retest those former highs. So for now, things are looking pretty bullish for the interest rates at the moment. And then when we take a look at our put-call ratio, this is an interesting one that I took a look at. I also put the S&P 500 down below it. So we've got the put-call ratio up top, S&P below it. And I put those on there just to show an interesting trend there. So we saw a massive spike in the put-call ratio this last week. And I find that pretty interesting because it's not just a little spike. And a lot of times we see spikes up to about 1.5 or whatever. And that's pretty common. But then when we start seeing levels above 2, that's really uncommon. And when we actually look at any kind of spike like we saw just this last week, the last time that happened was basically the COVID crash. So it doesn't mean that we're going to have a massive sharp sell-off in the markets for sure, but I think that's definitely something, a point of interest and something to keep a close eye on. I think it's definitely a warning sign that we're seeing some pretty elevated put buying protections. We actually had 2 weeks in a row where it spiked up above 2. Ultimately, it did subside down quite a bit lower, but they were still spikes nonetheless on the week. And I think that's definitely something to keep a close eye on. And I think it's definitely a warning signal to be cautious in the markets right now. And then we'll take a look at the dollar. This is actually the other chart that's kind of semi-bullish at the moment, but I think we're likely finding some support and it's going to reverse. But if the dollar were to drop down below about 103, then I think that would actually be potentially a short-term bullish sign for the markets. Typically a falling dollar helps support the markets to go up, and as we've seen the dollar sell off quite a bit over the last few months, that coincided with a nice little bear market rally that we had. And so if we did see 103 lose support and then the dollar ultimately headed lower, possibly down to about 100 or so, then I think that could set us up for another bear market bounce in the markets. So that's another key chart I'm watching closely. But I do think this is just short-term drop in the dollar, and that 103 would be the lowest that'll find support, and then ultimately see a reversal here. I think we're basically putting a bottoming pattern in on the dollar after a pretty steep sell-off, and then I think there's a good chance that the dollar is ultimately going to head higher from here. Going into 2023 at some point in the first, really probably in January, most likely, I'd expect the dollar to probably reverse and head higher. But if that doesn't happen and we see it go below 103, that could be a signal that maybe there'll be a bear market bounce. But for now, as long as we're holding above 103, staying pretty bearish. And then when we take a look at our yield curves, we're still super negative on those, negative 0.55% on the 10 minus 2s, and we're at negative 0.39% on the 10-year minus 3 month. So these are also at record low levels. We're actually seeing some negative prints on these, lower than we've ever seen, going back multiple decades. So I think that's also a longer-term warning sign that there's a good chance we're going to see some big sell-offs in the market going into 2023. And then take a look at our VIX. We've been seeing a lot of just sideways price action and similar with the volatility. I think ultimately we're going to see a big move out of the VIX coming up here pretty soon, most likely to the upside. What I'm watching for there is a spike above 25. If we see the VIX rocket above 25 and stay above there, I think that's likely going to be when the markets head lower as well. So that's another key chart that I'm watching for that signal of potentially the next sell-off and the next leg lower in the markets. So that's it for the week, and that's it for the year as well. So thanks for tuning in. It's been fun doing this content in 2022. Looking forward to doing a bunch more in 2023. We're going to have some new videos that we put out, some different short content, some more educational focused stuff, talk about some of our favorite indicators, some more stock chart analysis, sector analysis, different things like that. So thanks for following along, and if you want to check us out, you can check us out at ToroAlerts.com or download our app. We've got one for stocks and we've got one for crypto.